Hello, aspirants. If you're gearing up for your exams, you know how crucial it is to have a solid grip on India's financial markets. So, in this explainer, we're going to break down everything you absolutely need to know for the 2024-25 period. We're talking key data, major policy reforms, the whole shebang.
Okay, so here's our game plan. We'll kick things off with the global economic picture to set the scene. Then we'll dive right into India's incredible story of resilience. After that, we'll unpack the wild ride in the financial markets, the absolute boom in primary markets, and some super important governance updates. And hey, don't worry, we'll wrap it all up with a cheat sheet to help you nail those exams.
All right, first things first. To really get why India's performance was so special, we've got to understand the world it was dealing with. And let me tell you, it was a challenging environment.
You know, the global economic engine was, well, it was sputtering, to put it mildly. The IMF actually had to downgrade its growth forecast for 2025. The final number? A pretty sluggish 2.8%. That really paints a picture of just how much strain and uncertainty there was out there.
Okay, this next one is a keyword you've got to have locked in for your exams. Geoeconomic fragmentation. It sounds complicated, but it just means the world economy was becoming more fractured. Think of it like this. Rising trade tensions and political shifts were breaking down those global connections, making everything way more unpredictable.
So, with the rest of the world facing some pretty serious headwinds, how did the Indian economy hold up? Well, this is where the story gets really, really interesting. It's a story of remarkable resilience. I mean, talk about a contrast. While the world was slowing down, India's GDP growth for 2024-25 was projected at a super robust 6.5%. This wasn't just good, it made India a true outlier, a major bright spot in what was otherwise a pretty gloomy global picture. And this chart, it just says it all, doesn't it? Take a look. This shows the IMF's projections for 2025. See that bar for India at 6.2%? It's just towering over the world average of 2.8%, and especially over the G7 economies, which were creeping along at just 1.2%. A total outperformance.
So you're probably asking, what was the secret sauce? Well, it wasn't just one thing. This outperformance was really driven by a perfect storm of positive factors. We had a strong comeback in agriculture, our services sector was as resilient as ever, the government was pushing hard on capital expenditure, inflation was cooling down, and, this is super important, both companies and banks had really healthy balance sheets.
Okay, so we've got a strong economy. How did that play out in the financial markets? This is where we see a fascinating push and pull of capital. Now, here's a twist. Despite our strong economy, those global jitters really had an impact. Foreign portfolio investors, or FPIs, pulled a massive 1.27 trillion rupees out of the Indian equity market. This was actually the second biggest annual outflow ever recorded. It was all about global fears and investors running for safety. So that leads to a huge question, right? If all that foreign money was heading for the exits, who on earth was holding up the market and keeping things stable? And the answer, well, it's a story of homegrown strength, our very own domestic institutional investors, the DIIs. They stepped up in a huge way, investing a record-breaking 6 trillion rupees. They were the powerful counterbalance, really showing the growing muscle of India's domestic investor base. Here's a super simple way to remember this dynamic for your exam. Just think, foreigners fled while the domestic defended. It perfectly captures the big capital flow story of the year. Easy, right? All right, let's switch gears a bit. We've talked about trading on the stock market, the secondary market. Now let's look at the primary market. This is where companies raise fresh cash, and this space just saw a year of historic, record-breaking activity. And when I say historic, I mean it. A mind-boggling 2.1 lakh crore rupees was raised just through things like IPOs and rights issues. To put that in perspective, that's a staggering 2.5 times more than the amount raised the year before. That shows some serious confidence in the market. So what made this boom possible? A big part of it was this major reform in the rights issue process. Just look at the difference. The old way took, on average, a painstaking 317 days. The new, revamped process, just 23 working days. What a game changer for companies needing faster access to capital.
Now, the SME IPO space was also on fire.
But to make sure things didn't get out of hand and to protect investors, some really important new rules were brought in. Things like requiring companies to have a minimum operating profit and putting strict limits on how much promoters could sell or how much IPO money could be used for general expenses. So to help you remember these crucial SME IPO reforms, just break them down into 3 key areas. First, a focus on profitability with new requirements. Second, better investor protection through limits on promoter sales and phased lock-in periods. And third, tighter control on how the funds are used with new allocation rules and caps on general spending. Okay, so we've talked capital raising, but that's not the whole story. There were also some really important updates on the regulatory side to improve corporate governance and just make it easier to do business. A big focus for the regulators was this group called High-Value Debt-Listed Entities. That's a mouthful, right? Let's just call them HVDLEs. Basically, think of them as the really big fish in the corporate bond pond. Making sure their governance is top-notch is absolutely critical for the whole market. So what exactly changed for these big players? Well, for starters, the bar to even be called an HVDLE was raised, doubled actually, to 1,000 crore rupees. They also created a whole new chapter in the regulations just for them to make compliance easier. And, crucially, they tightened governance, for example, by requiring a no-objection certificate from a debenture trustee for any big related party deals. Okay, that was a lot of information, I know. So let's pull it all together into the ultimate cheat sheet for your last-minute revision. This is the stuff you've got to know. All right, let's lock in these key numbers and concepts. The main theme? India's economic resilience in a fragmenting world. Remember the numbers that tell this story? Global growth at a sluggish 2.8% versus India's powerful 6.5%. The massive FPI outflow of 1.27 trillion rupees, more than canceled out by a record DII inflow of 6 trillion rupees. And of course, a record 2.1 lakh crore raised in the primary equity market. These numbers perfectly capture the dynamics of the year. And for any policy-related questions, these are the big ones you absolutely have to highlight. The rights issue timeline getting slashed to just 23 days, the toughening up of SME IPO rules around profit and fund use, the new HVDLE framework with its 1,000 crore threshold, and finally, looking ahead, the phasing out of open market buybacks starting April 1st, 2025 to boost transparency. So, all of this leaves us with a really big question to think about for the future. As our own domestic investors become a more powerful force than foreign capital, how might this permanently reshape the entire Indian market? It's a huge question that will likely define the next decade. We really hope this breakdown helps with your exam prep. For more deep dives like this, check out our channel, and if you found this useful, you know what to do. Please like, share, and subscribe.